Somewhere right now, someone is passing a trading challenge, cheering, screenshotting it, posting it, and in about 90 days, there's a very high chance they'll never see that money again. Here's the golden rule of finance. Nobody says out loud. When a business model offers to hand total strangers $100,000 with zero risk to itself, you are not the trader. You are the product. Over the past 3 years, a quiet mutation happened in the online hustle economy. The old grifts, dropshipping courses, crypto signal groups, Amazon automation gurus, they became too obvious. People stopped falling for them. So, in their place, something far more sophisticated emerged. A multi-million-dollar psychological machine wrapped in the language of Wall Street. It's called the prop trading challenge. It promises ordinary people access to institutional capital from their bedroom. Pay a few $100s, pass an evaluation, and a firm will hand you a live $100,000 account to trade. No degree required, no connections, just skill. That's the pitch. Here's what's actually behind the glossy dashboards, the MT5 platforms, and the influencer affiliate links. In most cases, that capital either doesn't exist or is never actually accessed. You're trading on a simulated server, and the entire business model depends on a failure rate so high it isn't a side effect. It's the product. Between 2024 and 2025 alone, somewhere between 80 and 100 of these firms collapsed. Some quietly, some overnight with the doors locked and the Discord server gone by morning. This is the anatomy of how that happened, how a handful of offshore firms built empires on non-refundable evaluation fees, and the quiet, brutal math that almost guarantees you were never meant to win. Let's start with the pitch itself, because the pitch is the first piece of engineering. Picture the ad. A 26-year-old in a rented Lamborghini standing outside a glass office he doesn't work in, holding a certificate that says "Funded Trader" in gold lettering. The caption reads something like, "I turned $500 into a 6-figure trading account. Here's how you can too." It looks like opportunity. It's actually a sales funnel, and you are standing at the top of it. Here's the structure. You pay an entry fee anywhere from $50 to $1,000, depending on the account size you want. In exchange, you get access to a challenge. Hit a profit target, usually around 10%, without breaking a set of risk rules, and you pass. Once you pass, the firm claims to fund you with real capital, and you start splitting profits, typically 80-20 in your favor. On paper, it's elegant. It mirrors how real proprietary trading desks on Wall Street actually work. Banks and hedge funds do allocate capital to traders who prove themselves. That resemblance is the entire product. It's what economists would call a prestige signal. The dashboard looks institutional. The language is institutional. Evaluation, funded account, scaling plan. Every word is borrowed from a world of real credibility and stitched onto a business model that in most cases has almost nothing to do with that world. And here's the part that makes it so effective on smart people specifically. This isn't being sold to people who think they're getting rich quick. It's being sold to people who think they're finally being taken seriously. Engineers, consultants, ex-corporate employees who are good with numbers and tired of a boss deciding what they're worth. The pitch isn't get rich. The pitch is you already have the skill, you just needed access. That's a much harder story to walk away from. And the packaging reinforces it at every touch point. Professional-looking terms of service, payment processors that look identical to legitimate brokerages, testimonial walls full of screenshots, payout confirmations, congratulations messages, 5-star reviews. None of it is technically illegal to display, but stacked together, it manufactures a feeling of due diligence you never actually did. You didn't research the company, you just recognized enough familiar signals to stop looking for reasons to say no. So they pay, and then the second engineering layer kicks in, the one that actually decides who gets to keep any of it. Here is the sentence that the entire industry is built to make you never ask out loud. Is the money I'm trading actually real? In the majority of these firms, the answer is no. Not during the evaluation, and in many cases, not even after you pass. What you are usually trading on is a simulated environment, a demo server dressed up to look identical to a live one. The prices you see are often mirrored from real markets, but the trades themselves never touch an actual liquidity provider. No real capital moves, which means from the firm's perspective, your trading skill is almost irrelevant to their revenue. What matters is whether you pay the entry fee and whether you eventually break a rule. And the rules are where the real engineering lives. Every challenge comes with a set of risk parameters that sound reasonable on the surface. A maximum daily drawdown. Say you can't lose more than 5% in a single day. A maximum overall drawdown, maybe 10% total. Restrictions on trading during major news events. Rules against holding positions over the weekend. Individually, these sound like professional risk management. Collectively, they function like a minefield with a very specific blast radius, one that's mathematically tuned to detonate during completely normal market volatility. Here's the part that should bother you. A 5% daily drawdown limit sounds generous until you remember that a single volatile news day in a major currency pair or index can move that much in minutes. Not because the trader did anything wrong, but because that's just what markets do sometimes. The rule isn't there to protect you from bad trading. It's there to create a statistically reliable trigger spread across tens of thousands of traders that a predictable percentage of them will hit, regardless of skill. And this is where the business model reveals itself completely. Multiple industry analyses and first-hand account reviews have pointed to the same uncomfortable pattern. For a large share of these firms, the overwhelming majority of revenue, analysts have put estimates as high as 80 to 90%, comes not from splitting profits with successful traders, but from the entry fees of people who fail the challenge or who get reset and have to pay again to retry it. Read that back. The firm doesn't primarily make money when traders win. It makes money reliably and predictably when they don't. That's not a trading business with a marketing arm. That's a marketing business wearing a trading costume. And here's what makes this especially resilient. In most jurisdictions, this entire structure sits in a regulatory gray zone. Because no real capital changes hands during the evaluation phase. Many of these firms argue they aren't offering a financial product at all, just software, a game, a simulation you pay to access. That framing has kept much of the industry technically outside the reach of the regulators who'd normally police claims like get funded or trade our capital. Some firms have faced scrutiny over the years. A few have had operations frozen while regulators sorted out exactly what kind of business this even is. But for every firm that draws attention, several more open under a new name, in a new jurisdiction, running the exact same playbook. And once you see the incentive structure clearly, a very uncomfortable question follows. If the company profits most when you fail, why would it ever design the rules to make failure less likely? Now, a business model like this doesn't scale on its own. It needs distribution, and that's where the finance influencer economy comes in. Not as a bystander, but as a load-bearing part of the machine. Most of these prop firms run affiliate programs. A creator posts a link, their audience uses the code to sign up for a challenge, and the creator earns a commission, commonly reported in the range of 15 to 30%, recurring every time someone pays for a challenge or a reset. Not just once, every single time. Sit with that structure for a second. The creator isn't paid when their audience succeeds. The creator is paid when their audience pays. Full stop. Which means the financial incentive for the person coaching you is structurally identical to the incentive of the firm itself. More attempts, more resets, more fees. Their advice doesn't have to be wrong to be compromised. It just has to be shaped, even subtly, by which outcome puts money in their pocket. And this is where the psychology gets genuinely dark. Because when a trader fails a challenge, and statistically the vast majority do, the near universal reaction isn't, "This system was designed against me." It's, "I need to be more disciplined. I need a better strategy. I need the coaching program that guru is selling." So they buy the course, they pay for the reset, they try again. The failure gets internalized as a personal flaw when it was in large part a structural outcome. That reframe from "the game was rigged" to "I wasn't good enough" is arguably the single most valuable psychological asset this entire industry owns. It keeps people paying and it keeps them quiet. And the firms know this, which is why so many of them run a parallel business. Coaching programs, mentorship tiers, paid Discord communities, marketed specifically to people who just failed a challenge. The pitch shifts slightly, not "get funded." Get funded this time with our help. It's the same funnel, one layer deeper, monetizing the exact frustration the first product created. This is the same mechanism that's powered predatory systems for a century, just wearing a new outfit. Blame the individual, protect the system, sell the individual a fix for a problem the system created. So, if the fast money version of this story is a trap, what does the real version actually look like? Real capital allocation, the kind actual trading desks and institutional investors operate on, looks almost boring by comparison. It's built on 3 unglamorous principles: capital preservation first, asymmetric upside second, and risk-adjusted returns measured over years, not weekend screenshots. Nobody posts a rented supercar for "I didn't lose money this quarter." But that sentence, said consistently over a decade, is closer to what actual wealth building looks like than almost anything you'll see tagged with "funded trader" on Instagram. So how do you actually tell the difference in the moment before you've paid anything? A few questions tend to cut through the marketing faster than anything else. First, who gets paid if I fail, and how much? If the answer is "the platform," immediately, in full, that's not automatically a scam, but it changes what kind of relationship you're actually in. Second, is the capital or the opportunity real and independently verifiable? Not "trust us," but something you could confirm without their help. Third, does the timeline being sold to you match how wealth is actually built anywhere else in the economy? Weeks and years, not a single weekend. And fourth, maybe the most useful one. Would this pitch still sound reasonable if you remove the urgency? Take away the countdown timer, the limited spots, the price goes up tomorrow, and just read the mechanics out loud, slowly. Most predatory offers can't survive that test. The good ones don't need urgency to make sense in the first place. Here's the uncomfortable truth this entire investigation points to. The most dangerous financial products aren't the ones that promise nothing. They're the ones that borrow just enough legitimate language, evaluation, funding, scaling, institutional, to make you stop asking the one question that actually protects you. Who makes money if I fail? And how much of the pitch depends on me never asking that? That question doesn't just apply to prop firms. It applies to every opportunity wrapped in professional-sounding language and a countdown timer. And it's exactly the kind of question that's easy to ask about someone else's decision, and strangely hard to ask about your own, especially when hope is already doing most of the thinking for you. That's really what this channel is for. Not to tell you what to do with your money, but to slow the tape down enough that you can see the mechanism before you're inside it. If you want a practical version of that question, something you can actually run any online business opportunity, funded account, or guaranteed program through before you commit a single dollar, we built a simple due diligence framework for exactly that. It's linked below. No pitch, no urgency, no countdown, just the checklist we wish more people had before they read the fine print. Until next time, trust the math, not the marketing.